Let's continue our discussion on business combination. Last time we started discussing the basic concepts, no? As an introduction lang, okay, without any details. So for today, we'll talk about the details of business combination. And then we'll have some illustration, no? Just to show you some examples on the accounting procedures under business combination. Okay, so this is the definition of business combination. Sabi natin last time, it occurs when two or more entities come under common ownership. So if you remember C, okay, M and A, what is CMA? Okay, C for consolidation, okay, this is when A and B, okay, old companies, okay, when they combine, there will be a newly created company. So this is now what you call consolidation. Ayan. Consolidation of entities. Now when we say new, this company or company C doesn't have any existing assets or liabilities. Okay? So bagong-bago yan, clean slate, okay? And in consolidation, these two companies will be dissolved and all their assets and liabilities will be transferred to C at fair market value. Okay? For merger, this is A plus B. Okay, well, this one A plus B equals C, new company. A plus B equals A or B. Okay, so assuming that A is our surviving entity, okay, B will be dissolved and all assets and liabilities of A at fair market value will be transferred to A. For acquisition, this is when A plus B is equal to A and B. Okay, both companies will still continue to operate as separate entities, but at the end of the reporting period, they are going to prepare consolidated financial statements. They are going to report or make reports as if they are one entity. This is when you have your parent and subsidiary. Okay, there will be parent and subsidiary relationship. For these two, there is no parent and subsidiary relationship. Okay, business combination will be covered by PFRS number 3. Okay, and in this standard, it defined business combination as the bringing together of separate entities. Take note, they should be separate, okay, at the beginning. Okay, and then you bring them together. Okay, separate entities or businesses into one reporting entity. Okay, so gaya ng sinabi ng Spice Girls, when two become one or two or more become one. The result of nearly all business combinations is that one entity, the acquirer, okay, the acquirer contains or obtains control of one or more businesses. Okay, the acquiree. Okay, so yan, nearly all. Okay, dapat nga lahat na lahat. Okay, and then anyway, we'll have more discussions about this, especially pooling of interest, which is actually an old concept, no? Soon we will get to this, but if you have extra time, please read or research on pooling of interest. Ta-da! Let me write that down. And also under PFRS number 3, such control may also result, okay, in parent-subsidiary relationship, which the acquirer is the parent and the acquiree, okay, a subsidiary of the acquirer. Okay, so, ayun. Now, it says it may. Okay, when it says it may, it also means it may not. So if it did not result to a parent-subsidiary relationship, it doesn't mean that it does not qualify as business combination. Pwede pa rin. If you remember consolidation and merger, there are no parent and subsidiary relationship, but still, that's part of business combination. Okay. So take note, PFRS does not apply to business combination in which separate entities or businesses are brought together to form a joint venture. Why we have a separate standard for that, okay? And business combinations involving entities or business under common control. Why, if you go back to PFRS number 3, let's go back to PFRS number 3. It is the bringing together of separate entities or business. So, it's not applicable to letter B because in letter B, these businesses or entities are already under common control. And letter C, business combinations involving two or more mutual entities. Hindi pwedeng mutual lang. Okay? There has to be an agreement. And then letter D, business combinations in which separate entities or businesses are brought together to form a reporting entity by contract alone without the obtaining of an ownership interest. Okay, so dapat meron po yan. Okay? Reasons for business combinations. Actually, there are a lot. But if you read these books, okay, these are the top reasons why there is business combination or why companies combine into one reporting or one existing entity. Number one is the cost advantage. Sometimes it's cheaper if you just combine forces and take advantage of each other's capabilities and resources as compared to starting another business just to compete with other entities in the same industry. And because of that, there is lower risk. Well, of course, talking about risk, there are a lot of risks here, no? Dami klase yan. You have market risk, financial risk, business risk, liquidity risk, and so on and so forth. But most of the time, we are pertaining to your operating, also known as your business risk. Business risk and your financial risks. Okay, so ayun. And there are fewer operating delays. Why? Because these are two entities, they already exist. No, you don't have to set up. All you have to do is after acquisition, you just continue the operations. And of course, if you've heard of white knight, avoidance of takeovers. So for example, if let's say you have X competing with Y and X is now planning to acquire Y, may hostile takeover siya. So to avoid X acquiring majority of the shares of Y, Y is going to seek the help of W, and W is going to acquire Y. Ayan. So that X will not be successful in acquiring the voting interest of Y or majority interest of Y. And then you have number 5, acquisition of intangible assets. Like for example, you have company A and let's say company B, wherein B owns a patent. Let's assume that B is a pharmaceutical company and B owns a patent of a certain vaccine. So ayan, instead of A developing this patent, or maybe A try to develop this vaccine, kaya nga lang hindi siya successful. So what A can do is to purchase the patent or just to purchase B, who already owns the patent for this vaccine. Yung mga ganung bagay. Of course, there are other reasons, but this is not our main topic or our main concern for this subject. Our main concern is how to account for business combination. Now, some concepts that you have to understand. Actually, this is just a review because this is already discussed in our discussion on the introduction. Let's continue. PFRS number 3 provides that all business combinations shall be accounted for by applying the acquisition method, also known as your purchase method. Actually, there are two kasi dati. You have your purchase versus your pooling of interest. And this one, okay, of interest is no longer used. Under pooling of interest, okay, assets are recorded at book value, there is no acquirer, and the control is not clearly identified. Okay, so yun, it's totally the opposite of the purchase method. This one is more preferred. Okay, that's why our accounting standards no evolved into using purchase method as the prescribed method. And let's just forget pooling of interest. This method views a business combination from the perspective of the combining entity that is identified as the acquirer. So again, under business combination, okay, most of the time, we look at the transactions at the point of view of the acquirer. Okay, later we'll talk about the acquirer. How do we identify that? But let's just continue. The acquirer purchases net assets and recognize the assets acquired. Okay, so there was a question earlier, sir, what about the assets of the parent or assets of the acquirer? Are we going to value them at fair market value? The answer is no, okay, because the subject for the business combination are the net assets, okay, of the acquiree. Okay po, so the acquirer purchases the net assets of the acquiree, okay, and recognizes the assets acquired and liabilities and contingent liabilities assumed, including those not previously recognized by the acquiree. Okay, so we'll go back to this part soon. Okay, because in the process, okay, there may be, let's say, expenses, no, or assets that are not in the books of the acquiree, okay, which were identified in the process of business combination. So if they were identified, then that's going to be considered by the acquirer. The measurement of the acquirer's assets and liabilities is not affected by the transaction, nor are the additional assets or liabilities of the acquirer, okay, recognized as a result of the transaction because they are not the subject of the transaction. What transaction? Okay, business combination. So in short, we just focus on the net assets acquired or simply the net assets of the acquiree. Okay? So, ayun. Now, under the acquisition method, okay, you should be able to identify who is the acquirer, okay, determine the acquisition date, identify and measure consideration transferred or given by whom? By the acquirer, okay, also known as the selling price or purchase price pala. Purchase price, and then recognizing and measuring goodwill or gain from a bargain purchase. Okay, in some books they still use the term negative goodwill. I'll explain later. Paano ba yun? Yung negative goodwill. Goodwill, positive. If it's negative, then it's negative goodwill. But we don't use this term anymore. Instead, we use the gain from a bargain purchase. So this is the opposite of your goodwill. So how do we identify the acquirer? Okay. Now, take note, nabanggit na naman yung control, no? Control is the power to govern the financial and operating policies of an entity so as to obtain benefits from its activities. So, who is the acquirer? Okay, the acquirer in a combined entity, okay, that obtains control of the other combining entities or businesses. Ayan. So, the acquirer is the combined entity that obtains control. The entity that has the control. Ganun na lang. Okay, other indicators of which party was the acquirer at any given business combination are as follows. Okay, for example, no, you cannot identify or control was not mentioned in the problem, but this is mentioned. The fair value of one entity is significantly greater than that of the other combining enterprise. Therefore, siya yun, or that is now the indicator that that entity is the acquirer if it has a higher fair market value of its assets. Also, Okay, if the combination is, let's say, affected by an exchange of voting stock for cash, no, the entity paying the cash would be deemed the acquirer. So, kung sino yung nagbayad ng cash. Aside from that, management of one enterprise is able to dominate the selection of management, okay, of the combined entity. So, the dominant entity will be deemed to be the acquirer. Let's try to summarize that. Who is the acquirer? The one that gains control. What if the problem did not mention about control? Then there are other indications, no? The one that has a higher fair market value, okay? So that's one. The one that pays cash, okay, during acquisitions or combination, okay? And the one that has or that can dominate selection of management, okay? That's the power to select management. Okay, so there you go. How do you determine the acquisition date? Okay, so why are we talking about the acquisition date? Take note, we are discussing the acquisition method. And under the acquisition method, number one, you should be able to identify who is the acquirer. And number two, you should be able to identify the acquisition date. Okay, so what is the acquisition date? This is actually the date when the acquirer obtains control. So this is when the acquirer obtains control. Okay, the date on which the acquirer obtains control of the acquiree is generally the date on which the acquirer legally transfers the consideration, that's one, or acquires the net assets and assumes the liabilities of the acquiree, okay, also known as your closing date, okay. Remember, sir, bakit siya closing date? Can you talk more about your closing date? Actually, your closing date is the same as the date where you close your books. If you go back to your basic accounting, no, or sa partnership na lang. Let's say a sole proprietor, okay, joined a partnership, and then, okay, what will happen to the books of the sole proprietor, okay, if all assets and liabilities will be transferred to the partnership? The books will be closed, diba? Ayan, so in cases of merger and consolidation, ayan, because the acquiree will be closed, okay, the time where the assets and liabilities are transferred in the books of the acquirer, that is actually the closing date, okay. It signifies that the assets and liabilities are already assumed by the acquirer. So, meron na siyang control. However, the acquirer might obtain control on a date that is either earlier or later than the closing date. Okay, so paano yun? An example would be if the acquisition date precedes the closing date, okay, and there is a written agreement that provides the acquirer to obtain control of the acquiree. So what is your keyword? Well, there is an agreement that even if it's not yet the closing date, o kaya it's before or after, earlier or later. So if there is an agreement, okay, that the acquirer obtains control, then that is now the acquisition date. Now, the acquirer shall consider all pertinent facts and circumstances in identifying the acquisition date. Bakit kaya importante yung acquisition date na yan? Okay, later we're going to use your acquisition date to identify what is the measurement, because you have your measurement period. Okay, so what is measurement period? We will discuss that later. Now, still, under the acquisition method, okay, aside from identifying who is the acquirer, identifying the measurement date, should also be able to identify and measure the consideration transferred or given. Okay? Generally, okay, sabi ng standard, the consideration transferred or given by the acquirer is assumed to be the fair value of the acquiree as an entity. Kasi fair exchange yan, di ba? Okay, so if I'm going to pay 10 million pesos, it is assumed that the net assets of the acquiree is also 10 million pesos. Now, IFRS requires that consideration given in a business combination to be measured at fair value. Okay, this is calculated as the sum of the acquisition date, fair values of, or in short, these are the components of your purchase price, ayan, or your consideration. Number one, the assets transferred by the acquirer. Okay, so this includes your cash that were paid, or equipment or inventories, yan, or real properties which were sacrificed, no, in order to acquire the acquiree. Ayan. Or liabilities that are incurred by the acquirer. Like, for example, I'm going to pay you 10 million pesos and then I'm going to issue bonds pa, bonds payable, or I'm going to record ano ba, basta liability payable, okay, to the owners. That will be included in the consideration transferred. Also, the equity interest. O yan, yung mga shares of stocks that are issued by the acquirer. So, you have the assets given up, the liabilities, okay, which were incurred, plus, of course, the equity. O, diba? Assets, liabilities, and capital components. Add all of these three, okay? Get the fair market value and add these three. That is now your consideration. Okay po? Now, usual forms of consideration include cash, assets, contingent consideration. Okay, we'll talk about that here later. Ordinary or preference equity instruments, options, warrants, and member interest of mutual entities. I want to focus on contingent consideration muna. When we say contingent, okay, it depends. Yun eh. It depends on the happening of a certain event. So, a contingent consideration is a consideration which depends on the happening of a future event. Okay, so, ayun yun. The consideration the acquirer transfers in exchange for the acquiree includes any asset or liability resulting from a contingent consideration arrangement. So, pwede pala yun, no? Aside from the assets, the liabilities, and the securities which were issued, okay, additional, as an addition to your consideration or purchase price, is a contingent consideration. A contingent consideration is an agreement to issue additional consideration. It could be an asset or a stock at a later date if specified events occur. Okay, so ayun, consideration depending on the happening of a future event. Siya yan. The most common agreements focus on a targeted sale or income performance by the acquiring company. Okay, so it's based on certain performance. Now, contingent consideration is measured at the acquisition date fair market value. Okay, so the fair market value at the acquisition date. So this is one of the importance of identifying your acquisition date, because some of your considerations are measured, not just some, but all, no? All of your considerations are measured, no, at its fair market value at the acquisition date. Let's have an example. So, assume that Baguio Company issued 80,000 shares, okay, 10 peso par value, with a market value of 2,400,000 pesos on January 1, when the total fair value of the net assets of Manila Company is 1,800,000. Let's try to analyze this. Who is Baguio Company? Okay, Baguio Company is the acquirer. And Manila Company is the acquiree. Okay? This one is the par value of the 80,000. Okay? 2,400 will be the fair market value. In addition to the stock issued, Baguio Company agreed to pay an additional 200,000 pesos on January 1, 2012 if the average income for the 2-year period, take note, no? And it started in 2012. If the income from these two periods, 2010 and 2012, exceeds 160 per year. So this is now the event. So this 200,000 depends on 160. So this is now the event. This is now the contingent consideration. The expected value is estimated as 100,000 based on the 50% probability of achieving the target average income. Okay, so if there is 50% probability, let's say we can record it now. Okay, what's 50% of 200,000? That's 100,000. Okay, so let's try to analyze this first. If you were asked to compute for the purchase price, so can I just use ayan, purchase price or your total consideration? Okay, sige, let's just use consideration na lang. Ayan, your total consideration. Pinaganda lang yung purchase price eh. Okay, so first you have here your ayan, you have here your stocks, and the fair market value of your stocks is 2,400,000. Aside from that, you also have your estimated value of your contingent consideration. Contingent, how do I spell? Ayan, you now have your contingent consideration at 100,000. Therefore, how much is your total consideration? It's 2,500,000 pesos. Okay? The problem can also ask you, how much is the goodwill from this acquisition? Or how do we compute for your goodwill? You have your purchase price or your consideration less the fair market value of your net assets acquired. So we simply deduct the fair market value of net assets acquired. And in this case, it is, there you go, 1,800,000. So you have 2,500,000 less 1,800,000. This will be 700. 700,000 is now your sumobra. Is now your goodwill. Okay, now while we are at this, if your fair market value is higher than the consideration, you will now have a negative goodwill, and that will be your gain on business combination or gain from bargain purchase. Okay po? Your goodwill will be recorded as an asset, no, of the acquirer, but a negative goodwill will be considered as a separate item in the profit and loss statement. Okay, so you now have a gain on bargain purchase. Okay, so I guess that's it. Now, what if, no, what if we were asked to come up with, wait lang, sige, let's try to come up with the journal entry. How are you going to record the acquisition of net assets? Let's look at the problem. How you have a net asset of 1,800. Let's add some more information. Let's assume that this 1,800 came from your total assets. Assuming that your total assets are 2 million, ganun na lang, so that you will see the journal entries. And assuming that your liabilities are 200,000. So you get the difference. You now have 1,800,000. Okay po? So just try to integrate that in your notes. So what's the journal entry, okay, of Baguio Company? Okay? In the books of Manila Company, okay, your assets will be credited, liabilities and capital will be debited because it will be closed. No? But in the books of Baguio Company, the acquirer, we're going to record or debit assets. Okay, all of the assets at fair market value, at fair market value measured at the time of acquisition, which is now 2 million. Okay, and debit to Goodwill, which was previously computed at 700,000 pesos. You measure your liabilities, and it's given at 200, also at fair market value. Okay, let's write that down, at the fair market value of your liabilities. And then you have your contingent consideration. Contingent. Tama ba yung spelling ko? Contingent consideration. Consideration payable, okay, at 100,000. Okay po. And you have your ordinary shares. Ordinary shares. Ayan. Wait, I forgot what's the given. They issued 80,000 shares with a par value of 10. Okay, general rule, your shares are always accounted at their par value. So you multiply 80,000 by 10 and you will get 800,000 pesos. Okay, balance ba? You have 27. This one is 1. 27 minus 1,100,000, that will be 1,600,000. You now have a PIC or a credit to share premium. Credit to share premium at 1 million. There you go, 1,600,000. Okay, so you might be saying, Sir, Finor's balance mo lang ba talaga? Is that how it really works? Okay, well, it works. It works, pero another way to compute that, okay, is if you have the fair market value of your ordinary shares, no, the total of these should be equal to your fair market. Yun na lang, shortcut, okay? The total of these two should be equal to the fair market value of your shares that are issued. Okay, so I forgot. Let's go back. What's the fair market value of the shares? It's 2,400,000. Okay, 2,400,000. 800,000 is the par value. All the excess will go to your share premium. Diba? Ganun dun sa financial accounting and reporting. Okay, so that is within the measurement period. Okay, so feel free to pause the video and take some screen captures. Okay, zoom in and zoom out. Ayan, so yun na yung new normal natin eh. Anyway, let's continue. If the measurement period, patay na banggit na. Okay, if during the measurement period the contingent consideration was revalued based on additional information, the estimated liability and the goodwill or gain on acquisition would be adjusted. Goodwill or negative goodwill. Okay? Before we go there, let's talk about your measurement period. Normally, this is 1 year. Okay, in practice, within 1 year from the date of acquisition, no? Okay, so that you determine that this is the acquisition date. You add 1 year, this is now your measurement date. Okay, well, this one is actually subjective, no? It really depends how complicated, no, are the valuation is the valuation of your assets, parang ganun. Or ano ba yung process na ginagawa sa business combination. We're not actually strict with 1 year. Sometimes there are companies whose measurement period is 6 months. Sometimes it extends beyond 1 year. But normally it's around 1 year. If the problem is silent, we can assume that the measurement period is 1 year from the date of acquisition. Okay, so it says, if during the measurement period the contingent consideration was revalued based on additional information. Okay, you have to make certain adjustments. So, for example, if within the measurement period, the estimate was revised to 180,000. Okay, so originally it's 100,000, but then it was revised to 180. So that should be your contingent consideration payable. So you have to adjust this by 80 so that it will become 180. What about the other elements? Okay, they are not affected except for goodwill, which will now be increased by 80. Okay, so let's go back. How much is the purchase price or the consideration? It's now 2,400,000 plus you now have 180. Okay, so your new consideration is now 2,580,000 pesos. And then what's the fair market value of your net assets acquired? Okay, I think it is 1.8 yata because assets of 200 and liabilities, no, assets of 2 million and liabilities of 200, so that will be 1.8. So let's try this. Okay, less the fair market value of net assets acquired, and so this will now become 780. That's now your new goodwill. So previously, you recorded a contingent liability of 100,000 and a goodwill of 700. Originally, it's 700. But because of this change, okay, you have to increase the liability by 80 para maging 180 siya. And your goodwill from 700,000, it will now become 780. So you have to debit goodwill at 80,000 pesos. Okay? Sir, what if it's the opposite? O you just debit contingent consideration payable and credit goodwill. Ayan. Now, other things to consider. Changes that are the result of acquirer obtaining additional information about facts and circumstances that existed at the acquisition date and that occur within the measurement period. So, do you remember our measurement period? Okay, which may be a maximum of 1 year from the acquisition date. Okay, we already discussed that. Tatandaan nyo yan, ha? Okay, are recognized as adjustments against the original accounting acquisition. So, as long as they took place, no, within the measurement period and that this information is already existing at the acquisition date, you can make the necessary adjustments, which means it will affect your goodwill or gain on acquisition. Now, let's have another illustration. Okay, what if the estimate is revised after? Now, take note, our previous example, the estimate was done or identified during the measurement period. This time, it's after the measurement period. The adjustment is included in profit or loss for the later period na. Wala na tayong adjustment sa goodwill. Okay, for example, if the estimate was revised to 200,000 after the measurement period. Okay, so, sir, wala nang adjustment o di sayang? May adjustment. We still recognize this 20,000 as an increase in your contingent consideration payable. But since this adjustment already happened, no, after the measurement period, then your goodwill will no longer be affected. Instead, you're going to debit loss on contingent consideration payable. Okay, so that's for your contingent consideration. Some notes for you to remember. Changes resulting from events after the acquisition date, are not measurement period adjustments. Why? Kasi after. Accounting for such change depends on whether the additional information is an equity instrument or cash or other assets paid or owned, If it is equity, the original amount is not, again, not remeasured. Why? Because it's after the acquisition date. Okay? If the additional consideration is cash or other assets paid or owned, the changed amount is recognized in the profit and loss. Okay? An agreement to issue additional stock upon the occurrence of future event is treated to be a change in estimated value of the shares issued. Estimated value of what? The shares issued. And thus will not affect the value of your goodwill. No liability will be recorded at the acquisition date. The only entry made, okay, at the date when the only entry made is at the date when the additional shares are issued. Let's have an example na lang. Okay, so you have Baguio Company issued 80,000 shares at 10 par with 2.4, okay, when the total fair market value is 1.8, assuming that there was an agreement to issue 20,000 additional shares if the average income during the 2-year period of 2010 and 2011 exceeded 160 per year. Okay, so let's try to analyze, no? What will be the consideration for this? Okay, let's try to remove that and let's compute. Your purchase price or your consideration will be composed of the fair market value of your stocks. Okay, your stocks issued are valued at 2,400,000. Okay, and you compare the fair market value of net assets acquired, okay, which is 1,800,000. Again, your goodwill will still be, hindi pala still be. Your goodwill will be, is it 800? Yes, it's 800,000. Bakit feeling ko mali? Okay, wait lang. Let's get the calculator. Where is my calculator? Anyway, you just try to check on your math muna. 2.4. Okay. And then, no considerations. Okay. So, wala po yung 100 dito. Now, this one should be 600 dapat. I'm sorry. And 600 dapat to. Okay, so that is now 600,000 pesos. Okay. There you go. So what's the journal entry to record this? Okay, you're going to have a debit. You will now have a debit to assets of 2 million. Don't forget to record your goodwill. Okay, your goodwill will be 600,000 pesos. Okay, there you go. And then, you'll have your liabilities. I think that's 200,000 kanina. So you have liabilities of 200,000. Ordinary shares. Your ordinary shares issued is 80 times 10. It will still be 800,000. Okay, but the fair market value is 2.4, no? That's the fair market value of stocks. Less your ordinary shares of 800. This will go to your share. There you go. Share premium, also known as additional paid-in capital, amounting to 1,600,000. Now, if you're lazy to do the math, okay, you can force balance. This one is 2.6. The total for the credit side should also be 2,600,000. Okay, so that is now your journal entry. Now, assuming that the contingent event has already occurred, diba? Oh, wait lang. Let's go back. Let's try to review this. Yes, this is the journal entry when the event did not yet occur. Now, what if, no, the contingent event already occurred? Let's try to apply this standard. Okay, the standard tells us that the additional stock upon the occurrence of future event is treated to be a change in the estimated value of the shares issued. Therefore, we are going to make necessary adjustments on our share premium. Okay, let's go back to our problem. So, let's assume that the average income, okay, exceeded 160,000 per year. So, we are now going to issue additional 200 shares. What's now the journal entry for that? It's going to be a debit to adjustment, no? So, that's going to be a debit to your share premium, debit to share premium at 20,000 pesos, and credit to your ordinary shares also at 20,000 pesos. As you can see, we did not record any additional share premium and no adjustment to your goodwill. Okay, let's have a few moments for you to internalize that, okay, before we continue, okay? Ayan, let's assume you were able to understand that. You can pause the video, you can go back. Now, if you were able to follow through with our discussion, let's continue with other provisions, no? Or other concepts. Ayan. Under PFRS number 3, there is a discussion on acquisition-related costs. Now, when we say acquisition-related costs, okay, these are the costs that the acquirer incurs to effect the business combination. Okay, or these are attributable costs, kumbaga. Ano pa ba? Other costs that is related, o ganun lang. Like, for example, you have your finder's fee and other commissions, advisory or consultancy costs, legal, accounting, valuation, and other professional or consulting fees, general administrative cost, including the cost of maintaining an internal acquisitions department, and so on and so forth. Ayan. But ito, cost of, laging lumalabas ito sa mga exams, cost of registering and issuing debt and equity securities. Under PFRS number 3, the acquirer is required to recognize acquisition-related costs as expenses in the periods in which these costs are incurred. Okay? So, as long as they are related to your business combination, okay, you record them as a business combination expense. When? In the period when they are incurred. Okay? With one exemption, where the consideration transferred or given is the stock of the acquirer. So what about the stocks? The issue costs are usually deducted from the value assigned to share premium. Or in short, since share premiums are credited when the stocks are issued, okay, another way to understand this is your issue cost of the securities will be treated as a deduction to your share premium. We'll have an example soon. Similarly, the cost of arranging and issuing financial liabilities are an integral part of the liability issue transaction. Kaya, they will be included in the initial measurement of the liability as bond issue costs. Okay po? So, ayun. To summarize, basta they are expenses recorded in the period when they are incurred, except when these expenses are related to stock issuance, which will be treated as a deduction to the share premium. Okay? Of course, at the time of issuance. And, okay, issue costs pertaining to liabilities, like for example, bonds, will be included as a part of the initial measurement of the liability. Kasama siya sa bond issue costs. We'll have some examples soon. And how do you recognize, no? How do you recognize and measure goodwill, if it's positive, or gain from a bargain purchase, if it's negative? Okay, positive or negative what? I'm pertaining to the difference of the purchase price and the fair market value of your net assets acquired. Now, okay, let's try to read this. The fair values of all identifiable assets and liabilities. Take note of that. Just the identifiable assets and liabilities of the acquiree are measured and recorded. Fair value is the amount that the asset or liability would be bought or sold for in a current normal sale between willing parties. Okay? So, number 1, your net assets will be stated at fair market value. Or let's try to restate that. Your identifiable net assets and liabilities of the acquiree will be measured at their fair market values. Okay, why do we have to specify identifiable assets? Because if there are unidentifiable assets, they are not included in the valuation. Example of unidentifiable asset is your existing goodwill. Existing goodwill. And in your books, it's hard to identify. Okay, saan po nanggaling yan? So, you just remove that. Okay, the total of all identifiable assets less liabilities recorded is referred to as the fair value of net assets. There you go. Fair market value of net assets acquired. Siyempre, okay, coming from the acquiring. The identifiable assets should never include goodwill. Let's try to underline that. It should never include goodwill that may exist on the acquiree's books. Why? Because they are unidentifiable nga, di ba? The only goodwill recorded in the acquisition is the new goodwill. What is this new goodwill? The difference of your purchase price and the fair market value of your net assets acquired. Ayan. And that one is based on, sabi niya, price paid by the acquirer. Fair value of the net assets recorded is not likely to be equal to the price paid by the acquirer. What's this statement? Initially kasi, sinabi natin, okay, it is assumed that the purchase price should be equal to the fair market value of net assets acquired. Okay? But then, it's not likely. Okay, pag minsan sinosobrahan. Ganon. Okay po, kaya tayo nagkakaroon ng goodwill or gain from bargain purchase. The excess of the price paid over the values assigned to the net assets is the new goodwill. Okay, so again, let's try to understand that, no? The excess, ibig sabihin, if your purchase price is greater than the fair market value of your net assets, you will have a goodwill. What's the goodwill? That will be the excess of your purchase price. Goodwill recorded is not amortized but is tested for impairment on an annual basis. We have a separate standard for impairment. Now, where the price paid is actually less than the fair value assigned to net assets, a bargain purchase has occurred. O, di ba? You paid less than the fair market value of what you are acquiring. O, di nakawagwag yan, nakabargain na siya. And if that's the case, okay, if it's less than the fair market value of net assets acquired, it's going to result to a negative goodwill, also known as a gain in business combination or gain from a bargain purchase. How much is the gain on bargain purchase? The excess of fair market value over the purchase price, or simply the difference of these two. Ganon din doon sa goodwill. Pero positive dito, negative naman dito. Okay. Pasensya na kung paulit-ulit. Gusto lang nating matuto. Recognition principle of assets acquired and liabilities assumed. Okay. We have to take note that the acquirer, the one acquiring. Diba? You still remember who is the acquirer? Okay, let's test nga who is the acquirer, the one that has the control. Okay, or what else? Okay, it may be the company that has the higher fair market value of net assets. Okay, maybe the one who paid, okay, for the purchase price, di ba? Or if the combination took place through issuance of securities, then that is the company that issued the securities. So that's now your acquirer. Sabi niya, may recognize some of the assets and liabilities that the acquiree had not previously recognized. Ito yung sinabi natin kanina. Okay, unrecognized assets and liabilities. For example, the acquirer recognizes the acquired identifiable intangible assets, okay, like brand names, maybe patents, favorite, okay, or customer relationship, that the acquiree did not recognize as assets in the financial statements because it developed them internally and charged the related cost to expense. Okay, so if that's the case, as the acquirer, you're not required naman. You may, if you think they are material, no, you may recognize them, okay, during the business combination. Accounting procedures. Okay, so let's start with some examples. Assuming, no, the combination is through acquisition of assets. Or let's review. If the combination is through acquisition of assets, this could be consolidation when there is a newly created company, okay, which will absorb A and B, di ba? Where A and B will be dissolved and all their assets and liabilities will be transferred to this new company. Ayan. Or merger, no? When A plus B equals, let's assume A as the acquirer, B will be dissolved, okay, and all the assets and liabilities will be acquired by A. So what will be our necessary journal entries? A business combination may involve the purchase of a net asset including any goodwill. Ito medyo questionable yan eh. Why? Because sabi, identifiable assets lang. Anyway, okay, the statement is safe naman. May involve. Ayan. Rather than the purchase of equity of another entity. Such a combination does not result in a parent-subsidiary relationship. Okay, why? Because consolidation and merger, di ba? Because the acquiree will be dissolved, wala po tayong parent and subsidiary relationship. Does not result in parent-subsidiary relationship. When will this happen? Okay, this happens during acquisitions or stock acquisitions. When A plus B is equal to A and B. After the acquisition of net assets, the acquiree is dissolved, okay, and therefore ceases to exist as a separate entity. Dissolved, and dissolved. What will they do? They are going to close their books. Okay, all assets will be credited, all liabilities and capital will be debited. Okay, and at the time when that is made, that is actually our closing date. Let's continue. Let's assume we have the following information. No? So again, feel free to pause the video, take a photo or screenshot, okay, and then continue. Ayan, so this is the subsidiary company. Okay, take note, it's just a name, no? I'm not saying that there is a parent-subsidiary relationship. I'm just saying that subsidiary is the name of this company and the name of another company is parent. Okay, prior to the purchase by parent company. So this one is the acquirer and this one is the acquiree. Okay, so you have the following information. Let's continue. Assume further that the board of directors of the parent company, the acquirer, determine the current fair values of subsidiary company, identifiable assets and liabilities as follows. So it says identifiable. So it did not include unidentifiable assets. Like for example, of unidentifiable assets, you have your existing goodwill. Okay, so let's have the first illustration. Okay, before we go, let's try to understand. You have P company acquiring S. Okay, and since this is through asset acquisition, S will be dissolved and it's going to close its books. It will cease to exist. All assets and liabilities will be transferred in the books of this company. Okay, P or parent company. Again, I'm not saying that there is a parent subsidiary relationship. It's just that these are the names of the companies. Okay po. So, ayun. And since earlier in our discussion, okay, the acquisition will be viewed in the perspective of the acquirer palagi. So if we are talking of what's the journal entry that should be made, okay, how will this be valued or presented or remeasured, okay, we will always consider the perspective of the acquirer. So let's continue. In our first illustration, let's assume that there is a cash acquisition. Okay, so the parent company acquires the net identifiable assets of the subsidiary company, okay, by paying 4,575,000 pesos in cash for assets and liabilities. Okay. Also, parent company paid the following costs associated with the business combination. So, you have professional fees and general administrative costs. Okay. There were no contingent considerations in the contract. So, what's now the accounting procedures required? Okay, syempre, in the books of the parent company. Kasi madali lang naman sa subsidiary. Okay? Close mo lang. Let's continue. You have the acquisition cost at 4,575. Okay? Less the fair market value of net assets acquired. So that will be assets less liabilities. And as you can see, it is equal. So there is no goodwill or no negative goodwill or gain. Ayan. If it's negative. Dali-dali lang. Diba? Okay. So that's the journal. That's the computation. If you are asked to show the journal entries, in the books of the acquirer, you're going to record the assets at their fair market values. Since there's no goodwill, you may proceed to the liabilities and then you credit the cash. And that's it. What about your business combination expenses? According to PFRS number 3, the acquirer is going to recognize this as costs or expenses in the period when they are incurred. So you are going to debit expenses at 165,000 pesos and credit cash at 165,000 pesos. Very easy. Okay? Let's continue. What if there is non-cash acquisition? This means that instead of paying in the form of cash, okay, you're going to give non-cash assets. Okay, so ayan. Sabi niya, if debt securities are exchanged to acquire net assets, ayan, liabilities accounts are credited. If equity securities are issued, okay, these are recorded at fair market value. Okay, so let's try to apply that. Assume the same data on case 1, except the parent issued bonds in exchange of the acquisition, for the acquisition of net assets of the subsidiary company. Now, let's say that the face value of the bonds is 3,660,000 and they are selling at 125. What does this mean? They are selling at 25% above the face value. Let's assume further that the issuance of bonds involved printing and engraving cost of 10,000 pesos, which was paid by the parent. Okay, so na-discuss na natin ito kanina. This is part of your bond issue cost. The accounting procedures required of parent company, okay, will be as follows. Let's try to compute. Okay, what is the consideration given? Again, the fair market value of what was sacrificed, 3,660, selling at 125. The fair market value of what was given is 4,575,000. Okay, And then the fair market value. There you go. Still, there is no goodwill. Okay po. So, what should be the journal entries kapag ganyan? Parehong-pareho lang, di ba? Sir, bakit pareho? Nagkataon lang that the fair market value of the bonds is the same with the cash involved from the earlier illustration. Let's try to go back. First illustration, that is your cash, 4575. Second illustration, although it's 3,660,000, but the fair market value is 4575. No goodwill. This will be your journal entry. Of course, okay, you record the liability. Okay, there's no credit in cash. Okay, and then you now have the premiums on bonds payable, which is 915. Okay, you record your bond issue cost at 10 and the other expenses at 165,000 pesos. A credit to cash of 175. So as you can see, the fair market value of the assets and the liabilities assumed were not affected. Okay po, this time instead of crediting cash, you credit the liability, of course, at its face value. Okay, and the excess will go to premiums on bonds payable. And okay, sabi natin, according to PFRS number 3, all expenses will be treated as an expense at the period when they are incurred. But if they pertain to equities, they will be treated as a reduction to share premium. If it pertains to bonds naman, they will be treated as part of our bond issue cost. Okay. Now, let's continue. Let's assume the same data in case 1. Except that instead of paying cash, okay, they are now going to issue 100,000 shares of its own, 40,000 par ordinary share. Okay, and the fair market value is 45.75. Okay, so parang alam na natin yung mangyayari dito, no? You have your share certificate, printing cost is 10,000. So I'll just show you. Okay, so again, pareho na naman. That's the fair market value. Nagkataon lang that the consideration given for the first, second, and this illustration is the same. Okay, okay, you will see that there is no goodwill. Okay, and just to emphasize the difference in the journal entries. Okay po? So, same entries for your debt assets. This time, you're going to credit your share capital at their par. Okay, and the difference will go to your share premium. These are your expenses. What about this? Okay, these are your expenses related to the issuance of equity. So, they will be treated as a reduction to your share premium. Okay, so let's try to summarize. Okay, at the date of acquisition, your net assets acquired will always be recorded at their fair market value. If the acquisition is through cash, you are going to credit cash. Through liabilities, you credit the liabilities. Through equity, you credit the equity. Of course, okay, any difference will go to your share premium or doon sa isang example natin, premiums on bonds payable. If your expenses are related to the issuance of bonds, it will be treated as a debit to bond issue cost. But if it is related to the issuance of stocks, it will be treated as a deduction to your share premium. Okay. So, I guess that's it. Let's continue. Let's have another case. What if the consideration given exceeds the fair market value? Kanina kasi in illustration 1, 2, and 3, okay, the consideration is equal to the fair market value. This time, okay, the consideration is higher than the fair market value. What will happen? You are now going to recognize goodwill. Okay? So, ayan, you can just read this. But I want to go directly to the illustration. So, assuming the parent is now going to pay 4,700 in cash, you have the following expenses. Let's compute for the goodwill. Consideration. Fair market value of net assets acquired. Positive. Therefore, that is now your goodwill. Okay? Let's try to record that. Okay, same entry as before. You record the assets and liabilities assumed at fair market value. But this time, since there is a goodwill, you are going to debit 125,000 for your goodwill and credit cash of 4,700,000. Now, your acquisition cost will be treated as an expense, okay, in the period when they are incurred. Okay? So, ayun. Now, case 4, fair value of net assets acquired exceeds the consideration given. This time, it's the opposite. Okay? The market value or fair market value is higher than the consideration. What's the fair market value ba? Kanina. Diba? Okay, so palitan natin. The fair market value of your net assets acquired is at 4,575. Let's try to compute for the consideration. Sabi niya, the company is going to issue 100,000 shares of its own 30 par ordinary share capital with a market value of 39. So what's the market value of these shares? It's 39 times 100,000. So that's 3,900,000. O, diba? 3,900,000 when the fair market value is around 4 million. I think it's 4,575. You can just go back. Okay. So, ayun. Parent company incurred 10,000 for the registration cost, okay, of these securities. Ayan. Let's see what will happen. That's now the purchase price or the consideration. Fair market value of net assets acquired. You now have a negative goodwill, but we don't use that term anymore. So this is now your gain on acquisition. How are you going to record that? Again, okay, assets and liabilities at their fair market value. No goodwill. Instead, you now have a credit to gain on acquisition. Ordinary share always at their par value. Okay? And what's the par? Diba? Magkano ba yung par? Balikan natin. The par is 30. Okay? 30 per share. So, 30 per share times 100,000, you now have 3 million pesos. Diba? So, ayun. And the difference will go to your share premium. This one is for your expenses, but since there is another expense pertaining to the issuance of an equity security, according to PFRS number 3, that will be treated as a deduction to your share premium. Ayan. Sir, what if there is no share premium or the share premium is not enough, okay, to cover for this adjustment? Then you go back to your financial accounting, wherein the difference will go to your retained earnings. Ayan, retained earnings. Now, one of the things that you have to take note, okay, from that example, in case the stock issuance cost exceed the share premium recorded at acquisition, the excess should be treated as an expense. Ay, expense pala. Oh, expense. Kala ko retained earnings. Ayan, so mali pala ito. Ayan. Again, must be reported as a separate line item in the statement of comprehensive income of the acquirer in the period of the acquisition. Ayan. Tada! Accounting procedures. Again, this time on the acquisition of shares. So, you just acquire shares. This means that, okay, the assets and liabilities will not be assumed or transferred to the acquirer, which means the acquiree will not be dissolved. So, under acquisition, diba? You remember na, under acquisition, this is where, yan, acquisition A plus B is equal to A and B. So, in an acquisition of shares, business combination, both companies involved in the combination continue to exist as separate entities. Kaya A and B pa rin. To effect this type of combination, the acquiring company or the acquirer exchanges its cash or securities for a controlling interest, not for assets, not for liabilities, but for controlling interest in the voting ordinary share capital of the acquired company or the acquiree. Historically, sabi niya, controlling interest was defined as the ownership of more than one half of another entity's voting rights. So take note, it's more than one half. So it's higher than 50%. In some books, kasi, just want to emphasize, no, in some books, they're using the term 51% and above. Not necessarily, because if your interest is 50.0000001%, that's still more than 50%. And you're still considered as that is still considered as controlling interest. Okay, in some books they don't use one half or 51 or 50%. Instead, they just use the term majority of the voting interest. Ayan. Okay, control is the power to govern the financial and operating policies of an entity so as to obtain benefits from its activity. So, we already discussed what is control and how do you identify if there is control. Under stock acquisition, okay, if you have majority of the voting shares, ayan, it can be safe to assume that you have control over the company. Let's have an illustration. Hindi pala illustration. Additional notes pa to. However, even if one of the combining entities does not acquire more than one half of the voting rights, okay, it might have obtained control of that other entity if it obtains, okay, number one, power over more than one half of the voting rights. How do you do that? If there is an agreement. Diba? Kahit na 20% lang. Actually, when we use, have you heard of 20% and above but less than 50? If you already have 20% of the voting shares, you are considered to be an entity with a significant influence. Let me write that down. Significant influence. More than 50%, you now have control. You know the difference of these two? Okay, control is the driver. Ayan, you are the driver of the car. Significant influence if your wife is riding with you. Diba? Okay, your passenger can tell you where they want to go, but who has the control? Okay, the driver. Ayun. Okay, power to govern the financial and operating policies of other entity, again, through an agreement. Power to appoint or remove the majority members of the board. O, diba? Even if you don't own the majority interest, but you can appoint the board. And we all know these people, they make the major decisions. No? They are in charge of decision making. Then, as if you already have the control over the entity. No, yan. Power to cast the majority of votes at meetings of the board of directors or equivalent governing body of the other entity. Okay? So, ayun. There are different ways on how you can obtain control. Not just acquiring more than 50%, okay, of the outstanding or the voting shares. But you can also have 1, 2, 3, and 4. Okay, so let's continue. However, the essential elements of a business combination classified as an acquisition of shares are that both companies involved in the combination remain to be separate entities after the combination. Na-discuss na natin yan kanina. A plus B equals A and B. Okay? Such business combination result in a parent-subsidiary relationship in which the acquirer is the parent and the acquiree is the subsidiary. Okay, and they are referred to as affiliated companies kapag meron ng parent-subsidiary relationship. Okay, so let's continue. Accounting procedure is very easy for this type of business combination because only the difference, sabi niya, the only difference is that instead of debiting assets acquired and crediting liabilities assumed, you record the investment in subsidiary as your debit. And then you credit the consideration that was sacrificed. I'll show you an illustration. Oh, ayan. Okay. Assuming that you acquired all 10,000 issued and outstanding shares of S company for 100 pesos. That's the par value. Okay? For how much? For 2 million pesos. The journal entry is as easy as debiting your investment in subsidiary company and credit your cash. As you can see, you did not record the assets. Liabilities were not assumed. Why? Because the assets and liabilities are not transferred to the parent. What we are doing here is just we are acknowledging, we are trying to measure our interest in the subsidiary. So it's just as good as saying na, uy, I have an interest amounting to 2 million to subsidiary company. How did you get that interest? Well, by paying 2 million pesos. Okay? If there are acquisition-related costs, again, same concept applies. Okay? They will be treated as an expense in the period when they are incurred. Unless okay, these expenses pertains to, number one, issuance of equity. Diba? Aside from cash kasi, you can also credit the equity securities or stocks. If that's the case, okay, you're going to record expenses as a reduction to your share capital. If that's not enough, it will become expense. Although in some books, if I remember it right, pwede yata sa retained earnings. Also, okay, if aside from cash or stocks, no, you issue debt securities naman, all directly related expenses pertaining to the issuance of a debt security will be debited to your bond issue cost. Okay, so that's it. Wala pong na-dissolve dito. At wala pong nag-close ng books. So there is no closing date. Okay, when it comes to acquisition or business combination through acquisition. Some notes for you to remember, okay? Take note that these entries do not record the individual underlying assets and liabilities na discuss ko na. Instead, you just record the investment account. Okay? And then there is no goodwill or gain on acquisition recorded by the acquirer. Okay? And S company will not be dissolved because they will continue to operate as a separate legal entities. And the relationship is now parent-subsidiary. Ayan, may parent-subsidiary relationship ka na. In short, these companies are now affiliates. Okay? So, if no further action is taken, the investment in subsidiary account would appear as a long-term investment. Long-term investment on P company's statement of financial position. However, such presentation is permitted only if consolidation were not required. We have a separate discussion on the consolidation of financial statements. Ayan. Okay? Ayan. Under the acquisition method, consolidated statements. Oh, take note, acquisition method. What is this acquisition method again? Your purchase method. Okay, you are required to prepare a consolidated statement of financial position. This is your balance sheet. After the business combination includes all assets and liabilities of all the companies. Okay? And, sabi niya, eto basahin natin. In a statement of financial position following the acquisition method, assets and liabilities of the acquirer are at carrying amounts or book values. While assets acquired, okay, so coming from the acquiree, will be at their fair market value. Okay po? So, ayan, maraming nagtatanong sa PM. Sana doon na lang sa page ninyo tinanong para minsanan, Sir, in our assignment, what will be the value of the assets of the parent or what will be the value of the assets of the acquirer? Okay, based in the books that I've given you, okay, only the assets of the acquiree will be stated at fair market value. The assets of the acquirer will be at book values. Again, why? As discussed earlier, these are not the subjects, no, for business combination. There is also a consolidated statement of comprehensive income or yung income statement mo. Okay, this one will be prepared by the acquirer. Okay, and sabi niya, okay, includes the operating results of the acquiree after the date of acquisition only. Medyo nakakalito yung part na yan. Okay? Why? Okay, so it's like this, no? Let's say that this is your timeline and this is now your acquisition date. Okay, so this one is your before and this is after. Okay. Now, let's assume there are two companies. Okay? So, you have the acquirer and the acquiree. Let's just use the parent as the acquirer and as subsidiary for the acquiree. You were asked, how much is the consolidated net income? This will include the income of the acquirer from the beginning of the year up to the end of the year. Okay po? So, assuming this is January 1 and this one will be December 31. So, kasama lahat yan. But how much of the results of operation of the subsidiary or subsidiary company or the acquiree will be included in the consolidated income statement? It will only be the results of operation after. Yun lang yung idadagdag natin. So, net income of the parent from that point to that point and net income of the acquiree from this point to this point. Well, it makes sense naman. Pero take note, no? After the acquisition date, okay, if we are pertaining to merger, no, merger and let's say consolidation where the acquirees were dissolved, o di ba wala nang acquiree after the date, no, after the date of acquisition, okay, or acquisition date, which means that all the net income, ayan, all the net income of the acquirer is now the net income of the acquirer plus the acquiree if the acquiree operated as a separate entity. So this one, this provision is only applicable, no? This provision is only applicable to stock acquisition. Why? Because, how do I write acquisition? Acquisition. Why? Because after the acquisition date, okay, the acquirer and the acquiree will still continue to operate as a separate entity. Okay, so, ayun po. So far, sana na-gets nyo yun. Some disclosure requirements, okay, now when we say disclosure requirements, they're still part of our financial statements. No? When you prepare your financial statements, sabi niya, the acquirer shall disclose information that enables users of its financial statement to evaluate the nature and financial effect of business combination. Okay? Ayan, that occurs either during the current reporting period or after the end of the reporting period, okay, as long as they are still relevant. Ganun. So, what are these? Maybe you can disclose the business combination agreement. How did you obtain control? Okay, or what are the considerations, okay, given up? Okay, even your contingent considerations, they have to be disclosed in our financial statements. And the acquirer shall disclose information that enables users, again, let me emphasize that part. Okay, acquirer dapat should enable users of its financial statements to evaluate the financial effects, okay, financial effects of adjustments recognized in the current reporting period that relate to business combinations, okay, that occurred in the period or previous reporting periods. Like for example, no, adjustments in our contingent considerations which affected our, let's say, your goodwill. Ganon. Those things, they have to be disclosed. Okay po? So, I guess that's it, no? If there's one thing I like you to take from this discussion, no, hindi lang pwede ang one thing. Some things that I'd like to emphasize, okay? You have to understand the different types of business combination, okay? Aside from the types of business combination, okay, you should understand the acquisition method, no? Acquisition method as discussed in PFRS. You know PFRS? Philippine Financial Reporting Standards. Okay, PFRS number 3. Ayun lang. Okay, and then how are you going to compute for the goodwill muna? So you have the consideration or the purchase price versus the fair market value of net assets acquired. Okay, what is goodwill and negative goodwill? What are the necessary journal entries? What if there are some adjustments? Okay, so ayun, kabisaduhin ninyo yan. Okay po? Okay, so I guess that's it. On our following discussion, okay, the focus will be on stock acquisition. Why? Okay, under stock acquisition, both companies, the acquirer and the acquiree, will continue to operate as separate entities. Okay, which means after the acquisition date, there are still necessary journal entries. Okay, so how do you prepare consolidated financial statements and all? Okay, sir, what about consolidation and merger? Actually, the journal entries related to consolidation and merger are only up to the date of acquisition. Only up to the date. Yung na-discuss na natin ngayon, date of acquisition. That's it. Because after the date of acquisition, okay, the acquiree will be dissolved. So, wala na tayong transactions after the date of acquisition. Okay, so I guess that's it and salamat po ng napakarami.